Hello, everyone. Welcome again to this week's episode of Policy and Profits. I am Antoni Esposito, founder and CEO of Ascalon 6 Capital. I am joined once again by E.J. Antoni, chief economist at the Heritage Foundation. E.J., my screens are going crazy. I'm not sure what's going on your end. How are you, my friend, and how is the week?
Anthony, same thing, going crazy here as well. It really is amazing how much things can change, right? In literally just 24 hours with the developments in the Middle East, with us going to war in Iran. Holy smokes, did I not even think this was a possibility? But here we are, right? It's had huge implications for markets, energy markets especially, as you know, somebody who trades these things not just day by day, but minute by minute, for crying out loud. So big impacts there. And at the same time, this is, let me put it this way, I guess, this is occurring just as we're seeing underlying trends in other data really start to turn a corner, which is very, very concerning going forward. And I think it's going to have real implications for the broader economy, obviously, but markets specifically.
Yep. There definitely is, and we're trying to figure all that out here. And I'm listening to all the talking heads and pontificators on the screen talk about, is it going to affect inflation? Is it going to affect rates and the rate decision and the Fed? The Fed's barely holding on with the data points that they deal with now. I don't know what they're going to do with this. And then there's the risk of a spread of more of a geopolitical incident, which seems to be the case. The big question, to your point, one of the big questions really has been inflation. And we know that energy is at the core of costs globally, right. Whether it's the actual product or whether it's the transport of the product. Energy is key. Obviously, the Middle East is a hub. And we're starting to see some headlines out and some news that's making markets shake and people wonder. One of those is that the Strait of Hormuz, which is kind of in control of the U.S., kind of not in control of the U.S., and being defended by the U.S., mm-hmm. There is 20% of the globe's crude supply travels through that strait. And that doesn't include, remember, food and supplies coming into the Middle East and supplying the nations that are actually there.
Right. We
also have some LNG news out, which was a big deal. And we actually have that snip from X. Qatar Energy decided that they were going to cancel all LNG contracts because of the damage done by Iran and attacks on it as a neighbor, which sent contracts into a spiral. Now contracts are at auction versus contracts that were decided upon with Qatar. So LNG costs rising, crude is up. I'll call the base at 60, 65 ahead of any talk about a war. We're up at 70, 78, 79 now. We've been here for the day, 79 and a quarter last on the front month contract. There's an issue here as far as energy. So my question to you is, how much of a ripple effect could we see and where would we see it? What would it take and where would it be?
Great question. I would say that the first thing you got to do is just immediately stop listening to, as you were saying, all the talking heads pontificating. Anybody who's trying to give you guarantees right now, just immediately discount everything else they're saying, because nobody knows. I mean, we didn't think we were going to war with Iran, right? We have no idea how many missiles they have left. We don't even know what stockpiles we have. When I say we, I'm not talking about the military. I'm sure they have a count of like Tomahawks and interceptors and everything else, but the public has no idea. So we don't know what the ratio is between the enemy's capabilities and ours. So it makes it really hard to trade on that kind of asymmetric information. And we have no idea what the administration is going to do. We don't know if they're going to put boots on the ground. They at first they said no, and now they're saying it's a possibility. At first they said this is just going to be like a couple of weeks, 2 weeks to flatten Iran, kind of like 2 weeks to flatten the curve. And now they're talking about, well, it could easily be 8 weeks or longer. Nobody has any idea which way this thing is going to go, if it's going to work out well or if it's going to go horribly wrong. We literally don't know. So don't listen to anybody who tells you that. All right. So what do we know? Well, here's what we know about things like oil infrastructure and liquefied natural gas or LNG infrastructure. These plants, whether it's drilling operations or processing, the cooling for LNG, for example, these are pieces of infrastructure that literally take multiple weeks to start up or shut down. So if you want to stop operations 2-3 weeks from now, you have to make that decision today. So when you're Qatar or any of these other countries, Iraq, and you're trying to decide, okay, what you're not even looking at, can I get through the Strait of Hormuz today? You're trying to ascertain, can I get through there 2 or 3 weeks from now? Because that affects my production decisions today. And that's why we're starting to see shutdowns on top of, like you mentioned, LNG facilities being damaged by Iranian missile strikes, right? So again, there are more wild cards than non-wild cards in the deck right now, which is why you have speculators pushing up LNG futures in Europe, 50% in a day, doubling almost over the course of just a few days, right? All right, so how does all this relate to markets here at home? I know I've heard a lot of people say they've really been discounting the fact that you're seeing Brent spike more than WTI. So Brent is going to be that global standard for crude outside the U.S., and WTI West Texas Intermediate is the standard here at home. Well, guess what? It's not as if those energy prices abroad don't affect us here at home. I can give you just one quick example. I was talking to a farmer on what was that, Monday? Yeah, just on Monday. And he was explaining to me how he's having to buy all of his synthetic fertilizer basically from overseas because the environmental regulations have made it impossible to produce it here at home. What is synthetic fertilizer made from? Where do we get that urea? It's made from natural gas. So Europe buys LNG, and one of the things they do with it is they turn it into urea, which goes into the synthetic fertilizer that our farmers buy here at home to grow food. What I'm getting at, Anthony, is the fact that energy price fluctuations like we're seeing, whether it's in Asia, whether it's in the EU, you name it, those are going to affect input costs, and they're going to raise prices on all kinds of things that we buy here at home. To illustrate that fact, if you look at inflation under the first year of the Trump administration, the core inflation for a long time there, which excludes the volatile categories of food and energy, core inflation was actually incredibly steady. And so what was really changing the headline number were the fluctuations in energy prices. And as things like the price of gasoline came way down to start the Trump administration, what happened? It dragged overall inflation numbers down. Now, over time, because again, like we were just saying, energy is an input everywhere throughout the economy, those lower energy prices started putting downward pressure on core, and now we have gotten core down pretty substantially. But that means that the higher energy prices that we're seeing today stand to unravel literally all of that good progress. So that's a big headwind going forward for overall economic growth. I'm not trying to sound like Armageddon here, but I want to really get through to people how much this is going to affect markets. This is not, if again, we don't know how long the war is going to go. If it goes more than just a few weeks, this is going to have a big impact.
Yeah, I don't disagree. That makes sense. And in broad stroke, it's the market is trying to digest exactly that information. And we have a lot of people talking about how war is good for the markets and the market's going to rally. And they're starting to talk back about software, and the losers have been washed out because we've seen this massive drawdown in software, and you got to buy the winners. And it's the typical Wall Street permabull talk your book conversation right now. I don't know that applies right now to the market and the structure we're in. We're in a position in my mind where we have a realization in technology, in particular in large cap technology and software, that the story might not be as good as we thought. We have a real private credit. There's some smoke. We're seeing some funds and some loans go up. We're seeing some haircuts, stuff we haven't really talked about since 07, 08. We have all-time highs in prices and in valuations, which is not great. And structurally, the market is breaking down. It's running to the end of its cycle. Now, to be honest with you, we've been looking at this weekly chart. I want to revisit this because it really is giving us a good view of the market and where we stand. The war in Iran aside, we have been talking about this ascending wedge on the weekly S&P 500 chart, and I'm referencing here the front month contracts for the S&P 500 futures, but we've been referencing this now for 3 weeks. 6,400, you can see, was prior resistance before that big sell-off heading into the tariff tantrum. We had negative momentum heading into that on the double top. We're now in a position where, if you fast forward to the end of the chart, we have negative momentum on the weekly. That is not positive. That is not a good thing. We have an ascending triangle where the support is now being broken. The catalyst is irrelevant. The headlines are irrelevant. This is a fact where support of a major long-term bearish formation is breaking, and that's suggesting that we have a move down coming. This formation should officially break anywhere between last week and three to 4 weeks from now. We're seeing it break now. You see a violation on this. This was actually earlier in the week. We're actually below that line, live trading now at 67.90. And if you look at a measured move down from this formation, we should hit 6,400, which is exactly going to be where those two circles, that double top was heading into the end of last year, December of 24 into Jan of 25. So that's exactly where we are now. And that's exactly where we expect the break and the support to be. This is a real formation. And I think people really need to be honest with themselves, their advisors, their portfolio. I'm not telling you, again, your hair is on fire, sell everything and, buy a shotgun and canned food. What I'm telling you is it is time to realize and come to the conclusion that a downside move, a significant downside move, is very likely at this point. It's not that complicated. We are at the end of a massive run, at the end of a cycle. It's time for, at minimum, a correction, potentially a bear market, a cyclical bear. This is the evidence you need to look at, in my opinion, and this is what's going to project where we should look to find some support, and it is 6,400.
Mm-hmm. And Anthony, if I remember correctly, when we last spoke, which was before this war in Iran broke out, you were talking about the fact that there was so much potential downside risk in markets, right? And again, if I remember correctly, you were outlining the fact that it was time to start essentially getting into that short position, right? Am I correct my memory if I'm off here, if I'm oversimplifying things? But if you could, I guess just kind of tell us a little bit about how you were positioning things before, even before the whole war in Iran broke out. That'd be awesome.
Yeah, for the month of February, even tail end of January, we've been positioning net short. Part of the problem has been we've been in a very tight, actually a historical tight range. We're in the tightest trading range for the S&P for the beginning of a year in history. We've never had such a tight trading range, so consistent in history. And part of our problem in positioning short was it was a quick pivot back and forth and back and forth and back and forth. We run a technical momentum trend strategy here. Momentum trend does not like churning in a channel. It likes momentum and trend. So we the way we handle that here is we start to size down and pare down our position size. We stick to the model and the rule. And then on the break of the channel, that's when the real trade starts. So we've been positioned net short. We were actually heading into the weekend. Fortunately, we were short U.S. equities, that's S&P 500 and Russell futures. We were actually long gold and long crude based on the model. And those trades worked out extremely well. I wish there was a better reason for the trade to have worked, but worked out very well for this month, for March. And the month so far has been a very productive month. I mean, we're head down and we're focused on the screen in the portfolio, but we're doing, I think we're doing a good job of managing a pretty difficult market. And I think we're on the right side of the market in our short stance.
Awesome. How about energy? Because I know obviously oil's part, right? Oil's part of the portfolio, and then you have volatility as well. So what are those two looking like? And if you could, I guess talk a little bit about your positioning right now, and really over the last couple of weeks, right? And what your thoughts are on those as well, because I know it's not just the S&P for you guys. Obviously, a big component, right? No. But not just that.
Yeah. No, the equity component has been key, the S&P and the Russell. Crude for us, we've been net long through February. We were, as I said, long heading into the weekend. And we have actually stepped out of crude at this point. The headline risk, and it's so headline driven at this point that I really don't have a reason to think that the model could be ahead of or adjust or recognize all of the back and forth we're going to see. And the moves are quite aggressive. Gold is pretty similar. We were in gold. We've been net long gold. We haven't been short gold all year. However, coming out of the weekend, again, it's headline driven. Gold obviously had a tremendous run. Momentum's getting spun around. I would say that trend is obviously up. But I don't know how the consolidation plays out, and I don't know how the headlines play out. And we're getting some weird movement now as far as the rates conversation. The dollar's been extremely strong since Monday. And we have a situation where we have the 10-year yield now rising. So we have the opposite of what I expected based on the event. So those interest rate sensitive, headline sensitive gold and crude, which are 2/5 of the portfolio, we've kind of put to the side for now. Reluctantly, I do want to be in them, but I just can't in good faith put capital at risk, not being able to identify where I think we should be going based on our model.
Sure.
Equities, we lean short here. So we're short on the model and we're managing that position. We don't want to be too bulky at the wrong time because there is a pivot, there is a churn. We don't want to get run back over in the positions, but our positions are not, we're not day trading. They're longer positions. So we want to manage those positions, which is part of our job. And then the VIX has been incredible. We've had some of the best trades this year have been long front month VIX or options on the VXX, which is the front month, second month VIX ETF. There has been some real tremendous gains there for the portfolio. We've benefited from that heading into this. Right now, we actually came out of our final leg of the VIX position today and waiting to re-enter that position. But that's been interesting. Spot VIX versus the curve and the futures have been productive as well. So just to reiterate, the 5 asset classes that we trade here in futures, our universe includes S&P 500 futures, Russell 2000 futures, crude oil, WTI crude, gold, and front month VIX. That's kind of our world. And we're working through it based on our quant model and then based on our rule set that we wrap the quant model with. So we've been very fortunate this month. It is a very difficult month as far as markets go, but so far we have managed well, and we continue to do the best we can for our investors.
Love it, Anthony. And again, I know we've said this a million times before, but every time you have one of these situations, I feel like it bears repeating. What a blessing to have a quant-based model and to be using that versus the other two things that we see so much, which is number one, just the constant buy and hold and the dollar cost average, and right. And then, okay, you get nothing special out of that. Or number two, the I guess higher risk, higher reward, but it just feels like more risk in the long run. The folks who are just kind of playing everything by feel and don't have that quant-based model. And those are the folks I feel like you so frequently hear about just getting completely wiped out. Right. And so again, like kudos to you guys for the way you run that fund and the way that you rely on that model so heavily, because the numbers are what they are, right?
Numbers are what they are. We know on a quantified basis, we know what our portfolio volatility is going to look like. And it's going to be, there's some volatility, but we have an expectation and a track record to show what it should be and where the expectation is. When you trade on feel, you do really well until you don't, and you can give back, years of profit in 1 or 2 really bad trades or 1 or 2 really bad months. So that's not the game that we want to play. The only thing I would say is we have explored both investing in a winery that doesn't produce any wine and Nancy Pelosi's options strategy. So we're in negotiations there. We think we can do a little better on returns. With those 2 investments, I'll keep you up on how that goes.
Terrific. So glad to hear.
EJ, my friend, thank you for the insight. We will take a step back for the next week, see how things go, and I'll talk to you then, man. Have a great night.
You too, Anthony. Have a good one.